Welcome to the second lesson in Introduction to Banking. In this lesson, we shall first briefly look at the various functions performed by a typical commercial bank and then the various types of deposits. The functions of commercial banks are broadly classified into primary functions and secondary functions. Primary functions refer to the basic functions performed by a commercial bank, and these include accepting deposits, making payments, collecting and clearing checks, and advancing loans. Secondary functions are ancillary functions, and these include agency functions, general utility functions, and other functions. Now let's look at the primary functions a little more closely. Accepting deposits is the first and foremost primary function of any commercial bank. You must bear this in mind, that deposits are the lifeblood of a commercial bank, as its survival, growth, and profitability depends on how effectively and efficiently deposits are accumulated. Commercial bank deposits are mainly of three types. Current deposits, also referred to as no-cost demand deposits, savings deposits, referred to as low-cost demand deposits, and term deposits, which are referred to as high-cost time deposits. A prudent banker strives to strike an optimum mix of these three kinds of deposits in order to ensure stability, maximum profitability, and growth. Also known as demand deposits, these deposits can be withdrawn at any time. Generally, no interest is allowed and the customer is required to maintain a minimum balance. Checking accounts are maintained and withdrawals are made through checks. The frequent deposits and withdrawals is a characteristic of these accounts, requiring bankers to keep higher cash levels to meet withdrawal requirements. Overdraft or running finance facility is allowed in current accounts. This is the preferred mode for businessmen, firms and corporations, though there is no restriction on individuals for maintaining these accounts. These accounts are also exempt from zakat deductions. These deposits are the part of money supply, as they are used as a means for the payment of goods and services as well as payment of debts. Savings deposits are meant mainly for common people to help them conduct their normal financial transactions and deposit their small savings. The target market is salaried and self-employed people, small entrepreneurs, households, farmers, students, and pensioners. There was a time when there were restrictions on maximum amount of deposits and withdrawals and maximum number of transactions in a month, but these are now long gone. But bankers still prefer the transaction volumes in these accounts to remain within a reasonable bounds. A small interest is allowed on the credit balance in savings deposits. In some savings deposits products, this interest is calculated on minimum monthly balance, while in others, it is calculated on daily balances. A checking account, just like current deposits, is maintained and withdrawals are made through checks. Overdraft or running finance facility is not allowed in savings accounts. Zakat deduction applies to these deposits, and exemption is allowed to only those account holders who have submitted the required declaration. Term deposits are also known as time deposits. In term deposits, certificates of deposits are issued, also known as term deposits receipt or TDR. These deposits are made for a specific term and, theoretically, cannot be withdrawn before the expiry of this term. In case of premature withdrawal, penal interest is charged or a lower rate of interest is allowed. As an alternative, the depositor in need of money may borrow on the security of this deposit and pay a slightly higher rate of interest to the bank. Interest payment in these deposits may be terminal, periodic or compounded, depending on the specific terms and conditions of a particular term deposit product. Zakat deduction applies. Fixed deposits are liked by depositors both for their safety and as well as for their interest. Our first lesson concludes here. Thank you for watching.